want to learn how to manage your own investments? Are you ready to stop paying investment management fees and start building wealth? The DIY Investing Podcast is dedicated to providing you with the knowledge, skills, and resources you need to be a better investor. Learn how to make investments through the use of fundamental analysis, mental models, and business management insights. Now, here's your host, value investing expert, Trey Henninger.
Hello and welcome to episode 5 of the DIY Investing Podcast. My name is Trey Henninger and I'm your host today. Today's episode we will be discussing a specific stock idea which I find particularly interesting at this time. We'll be doing a deep dive on GameStop, ticker GME. GameStop in 2018 is a prime example of an investment with asymmetric risk and reward. First, I'll begin with a basic overview of their business model. So if you aren't aware of what GameStop is, they're a niche retailer with a focus on used video games. So when you go to their stores, they offer physical games and physical consoles available for purchase. They offer both new and used games that go with those consoles. So when I mean consoles, let me explain what that is for those not aware of the gaming industry. So console games are those produced by Sony, which produces the PlayStation, Microsoft, which produces Xbox, and Nintendo, which produces the Switch and other more handheld type game systems. So they specialize in those type of consoles and the games that go with them. So that excludes, for instance, PC games, which is another big part of the gaming market, but it's not what GameStop focuses on. Okay, so when we think about this gaming market for consoles, we need to segment them slightly. So they offer both used and new games, but they've primarily focused on the used video game market. And so if you own a physical game or console that you bought either from GameStop or one of their competitors online or Best Buy or somewhere else, you can bring it to GameStop and sell it back to them. And you can sell it back for either cash or trade it in for other games or other consoles. And this is the primary business model that GameStop focuses on. They get over half their profit from this sort of used video game and console market where, let's say you play a game, you beat it, You put in 40 hours playing it, cost you $60, you bring it back to GameStop, they might offer to buy it for 10 to 20, and then they'll resell it for 40. And so they have a very good profit margin in this business because for a gamer, depending upon the game, but some games are definitely games that you want to do a playthrough, you might play it through once or twice, and then you move on to the next game. You don't really go back to that same game. So it's very much a churn business where dedicated gamers can go through a lot of games at once, especially for younger players. Those below the age of 18 can get a lot of value from this used video game market because it allows them, without access to a lot of capital, without having a lot of income per se, to grow the value of their dollar. So if they receive a video game for birthday or as another sort of gift, they can play it, they can have fun, they can get the enjoyment, and then they can exchange it for other games. And they can then go take their used game and get someone else's used game, or maybe bring in 2 games, get 1 game back, and continue to play new games to them, but used. And so a lot of things have a big depreciation when they're used games, but when they're used, not necessarily games, but video games don't necessarily have that. When you play a used game, assuming it's in working condition, it's just software. So there's not a lot of wear and tear on the product. It's not like you're buying a car where the values drop significantly. The value can be just the same because what you're buying is the entertainment. So GameStop's really the only player in this business. And that's just the basic framework of how their business model works. They also have secondary businesses in collectibles and technology brands. So they have, when they began with the gaming industry, it's in more of a secular decline. There's an ongoing decline in this business, so they ended up deciding to diversify themselves. And so they bought into the collectibles business recently, and they also bought technology brands. And what technology brands is basically AT&T stores and Apple repair shops. So they have stores where you can go and take your Apple products, and they'll do repairs. I believe Simply Mac is one of their brands. And then they also have like 1,000 AT&T stores where it's essentially a commission model that AT&T, the business, pays GameStop a commission for any sales that occur at an AT&T store that's owned by GameStop. They don't give a lot of details into the actual structure of those commissions, but that's the basic structure that they get paid from. The collectibles business is really an interesting one. So one of their primary sources there is ThinkGeek, that has their own dedicated group of essentially researchers. And what they do is they monetize IP from other sources, let's say Star Wars, and they'll make unique products and come up with unique collectible products that can be sold to fans of that IP product. So you can have Star Wars products, you can have Frozen products. So they'll contract with Disney and make those products available. And as what you've seen recently is as the video game business has declined some, they have then brought collectibles into their store, and that's allowed them to manage their cash flow and profitability. One other aspect on business model, the GameStop business, and specifically games in general, is a very cyclical business, and this cyclicality is driven by the game system cycles. So as I said, they have really three main console brands that drives the business. So they have the Xbox, PlayStation, and Nintendo. And as you come out with it, as like Microsoft, Sony, and Nintendo come out with new versions of their marquee products. So instead of the Xbox, you get the Xbox 360, and instead of the Xbox 360, you get the Xbox 360S, and so on and so forth. Or PlayStation, you have the PlayStation 1, 2, 3, 4. Each level of those might have a 5, 6, 7, 8 year cycle in between. So there might be 8 years between PlayStation 3 and PlayStation 4. And what that does is when the new PlayStation 4 comes out, you get a big burst of purchases at the retailers like GameStop. And then you have kind of a lag of maybe a year or two. And then after a year, you get a bunch of video games sold back. And then, 2 years after that PlayStation 4 is released, GameStop start making a lot of profit from the sales of those used video games again. So they get the margin cover on those sort of things. But after that point, you see a decline kind of 2 years after, kind of year 3, year 4, year 5, year 6. There's a consistent sales decline until year 7 or 8 when let's say the PlayStation 5 comes out, and then there's a bigger jump in sales again as there's this cyclicality. And you actually see this cyclicality take place in the stock price as well, which is pretty interesting, because if we pull up a stock chart, and let me just basically, if you pull up for going back 15 years. So if we go back to like 2002, you'll start at like a $12 time frame, and then it runs all the way up to $62 in 2007, and then it drops down after it goes down to the cycle to again $15, $20 in the 2010s, 2011s, 2012, and then you're standing at $17 in 2012, and then before the end of 2013 you're back up to $56. So you get this huge jump of maybe 200% gains in a year, doubling or tripling your money. As the new consoles are announced, there's a lot of excitement in the gaming industry, a lot of sales, and then a steady decline. So the last peak was again in 2013, around 56, and it's gone all the way down now again to the $14 range. And so this cyclicality takes place over these long cycles. But there's a lot of money to be made if you time these cycles right. And it's not timing in the sense of market time, but just focusing on the value. So that's what I wanted to talk about today, is really the value that understanding the cycles of the GameStop business model can give, and also the value in understanding really what it means to have asymmetric risk reward. So the number one goal in investing is that you don't lose money. You want to make sure that you don't lose money when you're investing. So I'm going to switch gears and talk about the areas of concern in the business. So one of the key areas of concern is that GameStop has had declining profits recently. These profits have been steadily declining over the last few years. And again, this follows the cyclicality that I was talking about before. So since 2013, 2014, you've gone from profits in the 600 million range down to the 300 to 400 million range. Now, these are definitely real profits. You have cash flow accumulating to the business, but they have been declining, and it's been a relatively steady slope down. So each year you get lower profits for the company overall than the year before. So, your first concern really is, okay, well, how far are the profits going to decline? Are they going to continue declining? Will it ever turn around? So one of the key things to think about with GameStop and really to study, and so I encourage you to, if you are interested in GameStop, to do your own due diligence here and really take out their most recent 10K and read and study their business to see if you think these profits are going to continue to decline or if they'll ever turn around in a cyclical cycle. You'll kind of get an idea of how I feel about that as we go along. So that's one of the key areas of concern. The second area is this advent of downloadable games. So one of the key aspects that has been seen recently in the PC market, which is the segment that GameStop doesn't really compete in, is a huge shift in gamers starting to download games directly to their PC over the internet using software services like Steam and others, where they can go and just, I want a game, and instantly, click purchase, and then it will download over a period of an hour, 2, 3, 4, whatever it takes. And so you could have instant access or relatively instant access to your game. The console market, so Microsoft, Sony, and Nintendo, well, mainly Microsoft and Sony, have been, for the Xbox and PlayStation brands, have been trying to implement this as well. So what they're really trying to do is it allows them to cut out the middleman of GameStop as the retailer. So if they're able to successfully cut out the physical retailing market and just sell, instead of selling a $60 physical game that GameStop takes a profit cut of maybe $5, you now have a $60 physical game, or you still have a $60 digital game that Microsoft's able to take that cut, Sony's able to take that cut, and they retain more profit for themselves. So the availability of downloadable games has hurt sales of GameStop outside of the cyclicality of their normal business model. So this has been one of the key reasons, I would say, that the stock price has been descending recently over the last few years, as this process is thought to continue, because you've seen, the percentage of games that are being downloaded gone from 5, 10, 15, 20%, and it's approaching, 30, 40% and 50% type range. So the big question is, okay, will this continue to 100% and it's completely eliminate GameStop's entire business model? My basic thesis is that this is majorly overstated, because one of the key aspects is really understanding how different markets of gaming work. And so there's different segments. You have gamers who are very young, let's say young children below the age of 10. You have preteens, maybe 10 to 13, 14, and you have 13 to 18-year-old teenagers that are gaming. Then you also have adult gamers, anybody over the age of 20, 25, that are buying games with their money that they earned from working. So you kind of have a split group. You have those who have steady incomes, and then you have those gamers who essentially get gifts from parents or loved ones or otherwise. So those markets behave very differently. So I think part of the downloadable game structure has come significantly from those who have steady income. So if you have an income and you can justify a gaming budget on a monthly basis of $50, $100, something along those lines, you can regularly, if you see a game on your Xbox 360, you just pull it up and say purchase. Okay, so you purchase that game and bam, it'll be there in a day. And so then you can instantly get that, and then that you're able to justify that. But the other side of the market that depends more on gifts can't as easily make that switch over, because if you're 12 years old, you're not going to have a credit card. So you can't make that purchase without your parents' permission, and your parents aren't going to be allowing you to just willy-nilly purchase any video games that you want on a regular basis. So then you're more dependent upon gifts. Well, one aspect of gift giving that's always been significant is this idea of, trying to give someone something physical and watching them unwrap it, and really having that significance, this moment of gift giving, so that the gift recipient can show joy to the person who's giving the gift, and you kind of have that interchange. And so this is one of the key areas that GameStop fills, because now a downloadable code does not have the same, let's say, entertainment or happiness exchange effect of sharing and gift giving that giving someone a wrapped physical hard disk does. And so I think that's an area of this market that is perhaps overlooked when people talk about downloadable games reaching 100% of the market and completely eliminating the GameStop business model. The other aspect is physical video games have a higher value than a downloaded video game, because if you have a downloaded video game, there's a few things you can't do. Number one, you can't share it with your friends. And number two, you can't sell it and get money back. So the sharing is critical, because I remember as I was younger, I would play video games, and if I owned the newest Halo game and my friend did it, I could take it with me, go over to his house, and play Xbox with him at his house using my set. All I have to do is plug it into his Xbox, I bring my controller, he has his controller, and we can play there. With a downloadable video game, you can't do that. So your game is stuck to your profile, your system. But that's not the case if you have it set up in a different manner. So, and that's a key part of the gaming culture, is you have people who want to play games together. Certainly some people like playing alone, but it's very much an interactive, certainly people are getting more of the term esport, but it's really an interactive activity. And the other aspect is selling the games. So if you are on the receiving end of a gift of the game, it benefits you to have a physical copy, because if you were given a $60 game and then you can play that as much as you want and get a lot of value out of that, and you play it, let's say for a month or two or half a year or a year, you can, at the end of that, you can then take this $60 game and go exchange it, and maybe you can get now a $20 game from your $60 game. So now you're getting $80 of value instead of the $60 of value that you would have been given if it was just a downloadable game. And so GameStop is providing value there to its customers, to its specific part of the market that alternative companies like Microsoft and Sony directly aren't providing, and other companies like buying something off Amazon or going to Best Buy, who doesn't deal in used video games, are providing. And the second piece is, because they purchase used video games, they also sell used video games. So if they sell a $60 new video game, they might then sell the used version for $45. So while GameStop might make, but that $45 game they might have bought for $25. So the $60 game, because they didn't produce it or they didn't buy it, GameStop might make $5 from selling a $60 new game, but they might make $25 from selling a $45 used game. So GameStop's able to keep a much larger portion of that profit. So they're able to provide the value of a cheaper game to their customers. They're able to provide the value of the trade-in, and then they also are able to capture some of that value back. And so the final area of concern that I want to talk about today is the Amazon effect. So basically just this idea that all retailers are going to go extinct because they have physical stores and Amazon doesn't, so they can sell stuff for cheaper. And this has some true effects. I mean, you can certainly now order physical games from Amazon and have them physically delivered, and that kind of fills some of this gift-giving market, especially as the user base of Prime users goes up and you get 2 days shipping and delivery. There's definitely an impact for there. And that could certainly affect GameStop's business model, but it's not going to completely eliminate it, because there's a big culture built around going to the GameStop stores. They have demos set up where you can try out games. Parents can go and ask and say, hey, what's the newest hit video game that I want to get my 10-year-old son or 11-year-old daughter, and you can just ask them and talk to it, because most of the people who work at GameStop play video games themselves. I don't know if it's still in effect, but I know previously GameStop would have the ability for any of their employees to take at least one video game home to play and test out on their free time for free as one of their employee perks. And it was encouraged because it allowed them to build up a better knowledge base about the games that they were selling. So, okay, that's enough about the area's concerns. That's really what we're trying to figure out, if it's something we need to be worried about. So, but really we need to talk about then is, why am I interested in this company as an investment? And basically, it's very simple. The whole case for owning GameStop is built around their dividend. So they currently pay out, on a trailing 12-month basis, a dividend of 38 cents per quarter per share, which works out to $1.52 per year. So I'm going to try and limit the numbers on this discussion, but let's just get a general baseline of how you think about this. So if you don't know anything about the stock price, you can still have an idea of kind of what dividend yields might be. So, and this is where it's going to become key for this company. So when I think about when I want to own a company, I'm looking for a 10% hurdle rate on my investments. If I can earn 10% on my investments, that's a good return that matches the S&P historic return. And then anything above that is just going to be extra. So with GameStop, if I were to get a 10% of return just from the dividend, then you would take the $1.52 per year dividend, divide it by 0.1, would give you a $15.20 target price. So if you were able to buy GameStop for $15.20 per share or less, you would earn at least 10% of your return solely from the dividend. So it doesn't count the share price going up. It doesn't count a greater ownership of the company through buybacks made by the company. It's just the dividend payment that goes from your account, that goes from GameStop's bank account into your bank account. So if you can hit that price of $15.20 or lower, then you can hit a 10% hurdle rate on your investment. Well, okay, what's the most recent price? Well, GameStop was ended trading today on March 26th at $14.04. Okay, so you're below the $15.20 mark. So you're already set, if you were to buy GameStop today, more than a 10% rate just simply from the dividend. And that's only the payment hitting you. Actually, just on Friday, the stock was trading down to about $13.50. And so if you're talking about like an 11% dividend yield, you could buy it, as long as you bought it at $13.81 or lower, which is really close to what it is now, then you'd be earning approximately 11% from owning GameStop. And that amount, as long as the company maintains that dividend and doesn't reduce it, you're going to make that return from this investment. So your key aspect then is the dividend sustainable? Will it be cut? And the primary research that I would encourage you to do if you're interested in this company is, or any company that you want to base the investment on the dividend, is to research, is that dividend sustainable? Okay, so then we need to think about, what is the dividend sustainability mean? So dividends are paid from your cash flow and partially profits, but basically dividends are paid from cash flow. You want to see that the company is profitable, because if the company is losing money, it's not going to be able to pay dividends. But most importantly, that it has free cash flow. So the $1.52 per year dividend takes approximately half of the cash flow that GameStop produces. So normally people talk about dividend payout ratios. So you could say the dividend payout ratio for GameStop is about 50%. So in order for the dividend to be threatened, you'd have to see the cash flow or earnings of the company decline by almost 50% in order to prevent GameStop from being able to pay the dividend, which means that GameStop, in addition to having your dividend, also has additional set there to buy back stock or pay down debt or purchase other companies, anything that can help you make money. So really, your focus then is that you have this downside protection set up by the dividend, because if there's any decline in the stock price, then you're able to use that decline in the stock price to protect yourself, because you have this dividend. So, if the stock goes down by 10%, but you receive 10% of your dividend, then you're still even. You haven't lost any money. And so this is where the key aspect that I wanted to touch on comes into play. It's an asymmetric risk and reward, because your risk is very, very low. That means as long as you correctly ascertain whether the company can protect its dividend, then you're not going to lose money. Because if let's say there's a 100% chance that GameStop will not reduce its dividend, then now you're saying you have a 100% chance of earning 10% on this investment. Well, that's a great investment. So what your whole business then becomes determining, is that dividend protected? And so while your downside is there, because if the dividend can be paid and GameStop doesn't go bankrupt, you're going to earn that good return, which is above your hurdle rate. Again, that's one of the key aspects. If the dividend was 6% here, it'd be a different story, because then you'd have to get 6% from your dividend and 4% from the stock price going up. We don't require the stock price to go up or do anything. Stock price can go down, stock price can go up. It doesn't matter to you as long as you buy the stock at the right price. So then the upside part of the asymmetric risk return comes from the fact that this business is very cyclical. As I said before, you have these game system cycles. It is quite possible that GameStop is about to enter another one of these game system cycles. Nintendo just came out with their Switch in the past year or so, which focuses on handheld games. It focuses on the market that's all physical. So they don't have a market plan that depends upon downloadable games. They're kind of going away from what Microsoft and Sony are doing with the Xbox and PlayStation. Because they're doing that, you have this opportunity that they could ignite a major focus for GameStop as this cycle begins to play out over the next 2 years. In addition, we're also reaching that point of about 6 years since the last major cycle from Xbox and PlayStation. If a PlayStation 5 comes out in the next couple of years, you'd be facing another big push from players of the PlayStation 4 to come in and buy a new one, return their old PlayStations, and you're going to ignite another sales cycle for GameStop that could see the stock price rise significantly. So if you were able to, and there's no risk if the dividend's protected, because you could sit there and collect your 10% dividend while you wait for the sales cycle to turn around. And if it doesn't turn around, well, at least you made your 10% dividend. If it does turn around and the stock price doubles in, say, 5 years, well, now you've earned 15% per year from the stock price doubling, which is about what it would be after 5 years. If it happened 5 years from now, and you would have gotten an additional 10% from the dividend. So now you're looking at a 25% annualized return from owning GameStop over a 5-year period. It's not an unheard of, because this has happened previously. If you just go back and look at long-term cycles for this company, it goes in this cyclical effect. You can make a lot of money in cyclical companies when you buy at the low point in the cycle, just before the turn in the cycle. And so this is what you would see from the stock history. So just a final focus here then is that when you're looking to buy a company, one of the best things you can do is find companies with this asymmetric risk and reward. And this is where you have very little risk and a very high potential reward. So if you don't have a risk of losing money, which would be again focused on, is their dividend protected? Is the company going to go bankrupt or not? If that's in your favor, then you don't have any risk in the company. You're going to hit your hurdle rate even in the bad case that things don't work out in the cycle and the company business still looks bad. But then your positive end is if things turn around, you're going to make a huge return. So, it doesn't take much to make a lot of money if you're earning 25% annualized returns in investment. And I'm not making suggestions that that's what GameStop could earn. I'm just saying you can make a 10% return if you just take the dividend of this company. So then let's bring it in and focus on this concept of, is the dividend sustainable? I most certainly think that the dividend is sustainable because what they've done is you have this big protection between earnings so that it only takes 50% of their earnings to pay their dividend. They're also buying back a lot of stock. Stock price is really low. It's trading at something like a 4 PE right now, or a PE of 5, somewhere in that 4 to 5 range. And so they're able to retire a lot of shares by spending a small amount of money on buybacks. And that allows them as well. So as they buy back stock, they have to spend less money on dividend payments every quarter. So if you reduce the number of shares outstanding by 1 million, well, you've just reduced the amount of dividends you have to pay that year by $1.5 million. This adds up significantly when done at really low stock prices like GameStop's selling for. Basically, the reason it's so low, the company is priced as if they're going to go out of business. So if they don't go out of business, you're going to make a lot of money. So will they go out of business? My thought is that the answer is no. I encourage you to do your own research on this, but basically, as the video game business has declined, they have switched and put more and more of their collectibles business into the video game stores. So it used to be you'd have like 100% video games being sold at the stores, and now some stores now have 50% video games and 50% collectibles that tie in with the video games. So in the same spot where you might have a Halo video game, you might have Halo characters as little toy collectibles. Just as an example, or same thing with Star Wars or something along those lines. And this has the sticky effect of bringing customers into the store because GameStop's focus in the collectible business is unique products that are not available online. They can't be bought on Amazon, or they can't be bought at Best Buy because they're designed in-house by their in-house collectibles researcher and design team. And that makes it competitive and it protects their moat in this business. And one of the other key aspects with collectibles is that this collectibles business, if you look at the market as a whole, the market for video games is somewhere in the $12 to $14 billion range. I missed the numbers. Maybe it's 12 to 16 billion, somewhere in that range of total expenditures on a yearly basis. But the collectibles is also in that range. But collectibles are growing faster than video games are. So very soon, the collectibles market as a whole is going to be larger than the video game market. And GameStop has been consistently expanding their market share in this business over the past years, and I think they'll continue to do so. And as you see that, you might see a continued decline in the video game profit business, but you'll see an uptake that could offset it in the collectibles business. A brief take on the technology brands business. That business contributes maybe $75 million in profits, but I wouldn't assume a lot of growth because the company just announced a write-down on their purchase of a lot of those stores because they overestimated the return possibility. But it's still a significant brand set of stores that are still making profits. So it's not losing money, but we shouldn't expect any profit growth from there. So really, what you're going to have is you still have profit from the technology brands group. You have profit from video games, and that might be declining in the bear case where things are going bad for the company, but then that can be offset by the collectibles business that are growing. And I think it's quite reasonable when you're already at a 50% payout ratio that this dividend can be sustained over and over again. Because if you decline, let's say when you're buying back shares, if you buy back 4% of shares per year, then you could then raise the dividend by 4% per year and still pay out the exact same amount in dividend payments each year. So your dividend amount, even though you're raising the payout per share, the total payout would be the same. Alternatively, if you just lower the share count and you don't raise the dividend, which is what GameStop's been doing recently, it makes it easier and easier to pay the dividend, because instead of paying, let's say, $150 million in dividend payments in 1 year, now you only have to pay $145 million in dividend payments, because you cut out a bunch of shares that go along with those payments. And that should make it easier and easier for the company to maintain their current dividend payment. So in summary, buying in GameStop in 2018 makes this perfect example of what an asymmetric risk and reward can be. And so if you're listening to this later and GameStop's trading at a higher price, don't focus so much on GameStop. Focus on the ideas that when you're looking for investments, you want to look for this type of situation where you don't have risk and you have high reward. There's no reason that in order to achieve high returns, you need to take high risk. They don't match up together that way. Sometimes they can, but really the best way to receive high returns is to lower your risk as low as possible. So you're looking for low risk and high reward, and I believe GameStop in 2018 is a prime example of that. Thank you. The DIY Investing Podcast is presented for general informational and entertainment purposes only. I have not considered your specific situation or risk profile, and I have not provided investment advice. The information presented on the DIY Investing Podcast should not be construed as investment advice. The views and opinions expressed on the DIY Investing Podcast are those of the participants and do not necessarily reflect those of the show's host or sponsors. DIY Investing, its producers, sponsors, and host, Trey Henniger, shall not be liable for losses resulting from investment decisions based upon information or viewpoints presented on the DIY Investing Podcast.
Thank you for listening to the DIY Investing Podcast. Please visit our website and subscribe to our email list at DIYinvesting.org for guides, videos, and resources to help make you a better investor.